I'm Joe Galvin, Chief Research Officer of Vistage, here to share the insights and analysis from the Q3 2025 Vistage Quarterly Confidence Index. The Confidence Index is the definitive voice of small and mid-sized business CEOs. Our latest quarterly survey captured sentiment from nearly 1,400 CEOs over the first 2 weeks of September 2025. The Q3 Vistage Confidence Index rose fractionally to 81.9. While the index rose, it remains in a tight range since the pandemic. The post-election euphoria from Q4 2024 is a distant memory, as the realities, complexities, and challenges of today's marketplace become further entrenched. Each of the 6 factors that comprise the index saw a slight rise, but all remain at historically low levels. To gain clarity on what all this means, we once again turn to Lauren Seidel-Baker, Senior Economist at ITR Economics. Lauren is host of the ITR FedWatch podcast and has been interviewed on NPR Marketplace and Bloomberg. Many of our members have had the privilege and the pleasure of hearing and seeing her as she presents at Vistage Executive Summits across the country. Lauren, welcome.
Thanks, Joe. I'm so glad to be back.
Well, great, Lauren. The confidence index remains near historical lows. Economic and market uncertainty remains a top challenge for our CEOs, as they explained to us in our recent survey. Help us connect the dots between our CEO sentiment data and what you're seeing with economic data and where ITR sees the world going forward.
Absolutely. Uncertainty is the name of the game right now. One of the indices that I track is simply that, a policy uncertainty index. And I've been watching this one very closely recently and trying to find the tie-ins for how that relates to something like the CEO Confidence Index and just other sentiment. What we're seeing right now is that policy uncertainty specifically, it actually peaked at a higher level this cycle than it did even back in 2020, when, if you remember, the world seemed to be crumbling around us. We were at these unprecedented times. So I think that really speaks to the level of challenge that these business leaders are facing. Now, the other interesting part is that economic policy uncertainty, at least as measured by that one index, has been coming down. My question, though, as an economist, is that uncertainty coming down because it's being resolved, because we're getting more certainty, or are we just getting numb to so many of these factors? Are businesses pushing ahead with plans because at some point we might not have perfect information, but we have to move forward. We have to do something, keep running the business. So I really think we're in this mixed state right now. We don't have great information. There is still a lot, even on the policy front, tariffs especially, that really remains to be seen. But at some point, businesses are moving forward with their investment plans, or if they have hiring plans. We can't just stay on the sidelines forever. So as something like this CEO Confidence Index usually is a great leading indicator for example, our U.S. Industrial Production Index, it has about a 9-month lead time. It's giving us that sign of caution at the moment. The industrial economy is now growing. We're in an accelerating growth trend, but giving this slowing growth trend in the CEO confidence, that tells me that we are not firing on all cylinders. This is a sign to be a little bit more cautious, not too far out over your skis at the moment. And indeed, our forecasts are for growth across the economy, but a more subdued pace of growth. It's going to be much more muted this cycle.
Lauren, talk to us about interest rates. The Fed at its most recent meeting dropped it by a quarter point. What does that mean? And give us some insight of that as investments remain pretty strong with our folks, but still uncertain as to when that timing might be right.
And uncertainty there as well is growing. We did see in the September meeting a 25 basis point cut to rates. However, we're also seeing some of the messaging coming from Federal Reserve officials starting to diverge. We have the hawks and doves and a little bit more daylight between them rather than this greater consensus that we had been seeing. In the past, at least the past couple of years, rate messaging was a little bit more in line across various members of especially the FOMC. So if you look at the most recent dot plot, there are some relatively high numbers and kind of an elongated shape in that scatter plot of expectations coming from members of the Federal Reserve. And all the way at the bottom, we have outliers now. And it's kind of an interesting place to be. So as we move forward, the Fed is in a tough position trying to balance both sides of their dual mandate. On the one hand, they're talking about these cracks forming in the labor market. They don't want to see deterioration there. But on the other hand, we at ITR, and as we've been signaling to Vistage members, we're increasingly concerned about inflation picking up pace. So as those two sides of the dual mandate start to conflict, you get these different opinions about how much more rates can be cut, how many more cuts, and how deep into 2025 and potentially 2026 we could see those cuts.
As a follow-up, Brian Bolio in our July ITR webinar, he spoke about the importance of Fed independence. Can you elaborate on what that means for us and why that's so important?
Absolutely. So the Federal Reserve, their job is really to take a long-term view. And so I don't mean this next statement to be political. It certainly is not red or blue, but any politician in office, their job is to focus more on the short term, right? The immediate growth, maybe a re-election campaign, but more broadly than that, they're trying to just make things better today. They sometimes do that at the expense of that longer term, broad historic view. So whether it's a Republican or a Democrat in the White House, the tendency naturally is to front load growth as much as you can. And yes, lower interest rates are stimulative to that near term economic growth. So it's not a surprise that we would want to see more dovish policy coming from the political pressure.
Well, speaking of short-term pressures, inflation feels like it's more than what the numbers say, at least at the grocery stores that I go to. Talk to us about where we are with inflation, if you would.
Inflation has just started ticking back up. That, again, is why I don't think we'll get too many more rate cuts, maybe, marginally another 25, 50 this year, but that's not going to move the needle on economic growth. I personally see that pressure coming back to a much greater degree than the labor market, where there is some more fundamental balancing pressures from demographics. So when I talk about inflation, I want to be absolutely clear. We are seeing a broad set of fundamental factors driving pricing pressures. Everything from both fiscal and monetary policy have been trending more accommodative. We see this with wage pressures, as I just mentioned, that still tight labor market. We see this with commodities starting to pick up steam, with energy prices, electricity especially really gathering demand factors. You'll notice the one item I have not even listed yet is tariffs. That tariff impact is going to be an upside risk. It has absolutely not yet factored through to final demand. Our estimate is that it takes between 9 and 18 months for tariffs to fully affect final price levels. So we have not yet seen those full impacts from tariffs. And to be absolutely clear, that's not the only thing driving the inflationary train. If we could wave a magic wand, take all tariffs off the table tomorrow, that doesn't mean that we would go back to a low or disinflationary, certainly not deflationary environment. These pricing pressures are going to be with us. They're going to be coming from all sides. So for business leaders right now, your job is really to watch those margins, to not prioritize top line growth at the expense of that underlying profitability, that bottom line growth. That's going to be increasingly difficult in the months and years to come.
Lauren, a word we hear a lot more often now is stagflation. Help us understand, give us an ITR definition of what stagflation is and what does that mean should we see that?
The ITR definition is we are not there yet. So to be absolutely clear, we are hearing this term get thrown around frequently. Let's dissect the both halves of the word. Stag is for stagnation, for a stagnant economy. We are not seeing that right now. As I mentioned at the top of our time together, we are seeing the industrial economy starting to gain momentum. Yes, it's a slow momentum build. The ramp up is not all at once, but we're gradually gaining steam. We are technically in that accelerating growth trend. And on a GDP basis, especially, growth is here. This is not stagnation. This is certainly not a contraction. At this moment, the inflation, I'm a little bit more concerned about. The stag, I'm not quite so worried about, but we want to watch especially consumer spending habits. Today, wage pressures are still elevated enough that we're seeing wage growth outpace inflation growth or total price growth. So it seems like our consumer has that ability to keep on as the engine of the economy.
Yeah, Lauren, I'd like to go back to tariffs because I want to touch on and share some data with you. We found in our most recent survey, 33% have seen a decline of revenue as a result of the tariffs. 46% a decline in profitability, and 62% are increasing costs. You had said earlier, we're not going to see the real impact for it's coming up in this next window. 51% are going to increase prices in the next 3 months. Where does it end? What should we expect?
Absolutely. And Joe, if I'm surprised by anything in those numbers you just shared, I'm only surprised that they aren't higher, that everyone isn't feeling these pressures on the business side of things. Tariffs are much more quick to pass through on the microeconomic level than they are on the macroeconomic level. So let me unpack that. On the microeconomic basis, for example, we put a tariff on steel. Every time that commodity comes into the country, it's at that higher price, right? We have to add the tax on top of the price of the commodity. So on a microeconomic level, which is likely what many of these individuals are feeling, yes, your supply chain just got more complex. It's not just about the lowest price, highest quality producer anymore. There's a lot more nuance flowing throughout the supply chain. It's reducing some efficiency, certainly. But on the macroeconomic scale, as we talk about something like maybe the consumer price index as that level of inflation, that barometer that we're all used to looking at, that's where we don't see the pass through quite so quickly. CPI, for example, the largest individual component of that price index is shelter costs. And you could make the argument that, say, lumber that we have to import from Canada, for example, that might have a tariff on it. So framing, which is the most expensive aspect of building a house, yes, that would come at a higher cost. But you kind of have to do a few steps there to factor through to a higher priced home, and certainly existing home inventory that isn't hit by tariffs. So shelter costs, while they're rising for other reasons, that's not a one-to-one relationship. At the end of the day, the consumer will be insulated from these tariff effects, at least to some degree and for some amount of time. We're seeing that be absorbed either by the importer or by some intermediate seller of these goods, or even the intermediate components of various goods. There's going to be some absorption along the line, but you're right. For businesses, this is just another squeeze on margins, another profitability hurdle to overcome. And at the end of the day, another reason that you are going to have to be raising your prices unless you want that margin erosion.
Great. Thank you for that. Let's talk about the labor market, because after traditionally it's the top issue, talent management. After the uncertainty, it's still the number two. We see unemployment's ticked up, quit rates are down, retention is up. Concerned about 13% decreasing headcount, as we spoke before. And AI is not a factor in that yet, and nor do I think AI will be a super strong factor for small and mid-sized business when it comes to that, at least not for a long time. But in the meantime, your thoughts on the labor market and what we should be thinking about that?
So the labor market is getting a lot of attention, a lot of headlines right now, and the direction of travel is certainly one of loosening. Now, I like to remind audiences that we are coming from such an incredibly historically tight starting point. At the worst of it, back in 2022 or so, we had 2 open positions for every 1 unemployed worker. So it wasn't even a matter of finding skilled talent, qualified talent. It was just finding talent, anyone, a human being out there who can fill this job. Now we're seeing a little bit more, I'll call it normalization. That ratio is right at the 1-to-1 level. So 1 unemployed worker for each available job opening. Clearly, there are still skills gaps in certain regions, in certain sectors, certain skill sets. But overall, we're seeing a little bit more available labor. The risk that I have is that if we look back over time, our average number of workers, unemployed workers per job opening, it's usually higher than 1. So a normal job market for us, for business owners and certainly hiring managers, it feels like it should be multiple job seekers for each job out there. We're still not back to that level. And at the end of the day, where we go from here, we have a few key challenges, mostly with demographics. Baby boomers are now starting to retire. They, over the next several years, will be easing out of the labor force. And we don't have an equivalently sized generation coming in. Gen Z, they're actually a lot smaller of a generation. So purely mathematically, we don't have the same numbers leaving school, entering working age, as we do have rolling off on the other side, headed off into their golden years. On the other side of things, this year especially, I'm more concerned about negative net migration. That is our expectation, that the U.S. will lose immigrants this year, that is going to hit key sectors like construction, like agriculture a little bit more strongly. But again, drawing down that available labor pool, especially from some key areas that have a gap remaining. So I'm quite frankly worried about that 13% who say they plan to reduce headcount. I think it's going to be harder to hire back at the end of the day. Sometimes you do need to shed, say, underperformers, but maybe if some of that natural attrition, the folks that you wouldn't be too sad to lose, that might not be a bad thing, but please don't lose your top performers, because by the time you rehire into what is probably going to be a still relatively tight labor market, we're seeing that wage pressure reflected. We're still competing for these workers. I think it's going to cost more in terms of the talent search. I think you're going to have to pay more at the end of the day, just in terms of where wages and salaries are going. And that's before you even start to factor in the onboarding process, the training, getting them up to speed to where someone had been performing. So personally, I really am watching retention. I think that is a good long-term strategy. And anything you can do from that point forward, you mentioned AI, make your workforce more productive. That is going to be an amazing long-term winning strategy.
Lauren, before I let you go, what are your closing thoughts and advice for our CEOs? They're entering the all-important strategic planning cycle. And strategic planning has never been more important than it is now, especially with the uncertainty and volatility. Give us some closing thoughts as we enter into that thought about 2026.
I would be thrilled to. First of all, follow the hard data. If we can provide this at ITR, we would be happy to. You have amazing resources from Vistage. Don't get caught up in these headlines. There are many of them out there. They are really sweeping in a negative direction right now. But look to the fundamentals, and more than anything else, watch your margin. Be cautious. This could be an era of what we're calling profitless prosperity, which is that laser focus on growing the top line, but sometimes at the expense of profitability. Don't get caught up in that cycle, and anything that we or Vistage can do to help, you have great resources there.
Great, Lauren. Thank you so much for your time and your insights. We'll look forward to speaking with you again in December for the all-important Q4 Confidence Index. For all of our Vistage CEOs, please mark your calendars for December 1 to 15 to make sure your voice is heard through the Vistage CEO Confidence Index survey. It is the definitive voice of small and mid-sized business leaders in the United States of America. I am Joe Galvin. I am Vistage Chief Research Officer, and I thank you for your time. Look forward to seeing you again when we look at the thoughts and understand the insights from the Vistage CEO community. Thank you.